morning and welcome to Charting the Markets on Tuesday, the 31st of January. Now, the month of January has been surprisingly good for equity markets globally and has actually beaten a lot of the forecasts for the full year from some analysts. And over the last week, though, equity markets have been softening ever so slightly and trading sideways more than up. And earlier today, the IMF raised its global growth forecast to 2.9% from 2.7%, and also said that going forward, 50% of the growth globally will come from India and China. Now, on the back of manufacturing and non-manufacturing Chinese PMI readings moving back into expansion territory for December, reflecting the reopening of the economy and providing sentiment with some near-term support, and also lower inflation readings on the back of falling oil and gas prices, you would expect equity markets to rise even further. But that hasn't been the case, and probably because we are all awaiting now this week's plethora of central bank rate hikes. So we've got the Fed out on Wednesday and expect a 25 basis point rate hike there. And then on Thursday, we've got the European Central Bank and also the Bank of England, both expected to raise rates by 50 basis points. So let's just have a look at the equity markets and start off with the FTSE 100. And as you can see here, we have been trading in a downward channel on this daily chart since our mid-January high made a couple of weeks ago around just below the 7,900 mark. And earlier this morning failed at a downtrend channel, which has been in place over the last few weeks. And basically, so far, we've held at the current mid-January lows at 7,711, tested about 3 times over the last 2 weeks. But we'll have to see whether this time around we will hold here again, because if we don't, we are likely to head back down again towards the December to January uptrend line, which currently can be seen around the 7,655 mark. So that should be interesting to see. And then the question is, if it were to happen, is this just an ABC zigzag correction, meaning that, yes, we might retest the high seen back in December at 7,618 and consolidate a bit, and then continue upwards and make new all-time highs? So basically, with regards to the FTSE 100, rise above the May 2018 high, the all-time high back then, or is this the beginning of a more protracted decline over the next few weeks and months? So we'll have to see what happens with regards to this uptrend line test in the next few days or not. And if it were to happen, so as I said, as long as we remain above 7,711, the uptrend is actually still intact, or at least the sideways trading we've seen over the last few days is likely to continue. Now, moving on to the German market, the DAX 40 has also risen very sharply at the beginning of the year by about 7.5%, beating many analysts' estimates even for the full year. And here we can see also sideways trading, and basically the DAX 40 being in a band between 15,272 and 14,904 on this daily financial bet. And today basically coming off again. Now, as long as we can hold about 14,904, this sideways trading range is likely to continue. Were to give way, though, we could be heading back down again towards the early and mid-December highs between 14,677 and 14,606. So that would be our next downside target area if we were to slide through 14,904. For the upside to be back in play, we would have to rise above 15,221. And that's simply the high seen from last week. Moving on to US markets, and what we can see here with regards to the S&P 500, for example, is that we have tried to rise back towards the high seen in December at 4,139, but failed at 4,094 last Friday, and have been coming off since, and are currently sliding back towards the January support line here around 3,965. And that, together with the low seen on the 25th of January, and also the red line here, the 200-day simple moving average, going back down towards 3,940, should give us pretty good support going forward. And from a technical perspective, the medium-term uptrend we've seen since the end of December will remain in place as long as the last really important relative low here, that is to say the mid-January low of 3,886 holds. So that's the key level to watch out for over the coming weeks and months, together with the high at 4,094, because if we take that out, then we are likely to head above this 4,139 high seen in December, and also above the September high at 4,155, the mid-September high, and could extend much, much higher if that were to be the case. But right now, short term, we are coming off with regards to equity markets as we await the rate hikes, or the anticipated rate hikes, by several major central banks later this week. FX markets have been interesting of late as well, because the US dollar, for the first time in many weeks and months, has risen for 4 consecutive days. And if we have a look at the daily chart of the US dollar basket, what we can see here is on the daily financial bets that we are in the process of forming this minor bottom. As you can see here, we've got 4 green candles telling us that the market is trying to reverse to the upside, short term at least. Excuse me. But if you go onto a monthly chart, we will see that despite the short-term bounce, we have clearly had 4 consecutive months of lower levels with regards to the US dollar. So the strong uptrend we saw over 2021 and 2022 seems to have come to an end. And now we are also trading below the 2021 to 23 uptrend line, which currently comes in around 102.75. So on a monthly chart, the dollar basket looks quite weak. But on the daily chart, we are short-term reversing higher, and we may actually retest the uptrend line I showed you, which was broken through, which now acts as resistance because of inverse polarity, together with the December lows, the early to mid-December lows, between 103.08 and 66. So as long as we stay below 103.66, the downtrend is very much intact. And even if we were to be taken out, basically what we need to see is a rise above the January high at 105.37 for a bullish reversal to be made from a medium-term perspective with regards to the US dollar. And if you look at the inverse of that, that is the euro versus the US dollar, because the euro makes up 57.6% of the dollar basket. What we can see here is the inverse of the dollar basket, in that the euro-dollar exchange rate has fallen over the last 4 days consecutively, and is heading back down again towards the November to January uptrend line, and also the highs seen since mid-December, basically between 107.36 and 107.15. Actually, 107.66 is also support, because that's the mid-January low. So we've got really good support here, and we bounced off that support with regards to the non-farm payrolls data when that came out last time. And it will be interesting to see whether going forward we can hold above 107.15, because as long as we do, the uptrend is still very much intact. If we were to slide through there, we could see a deeper retracement lower towards the mid-November high, and also the early January low between 104.84 and 81. But right now, it's just a consolidation in a strong uptrend that we are seeing here on this daily chart. Moving on to euro sterling, what is interesting here is that we've been trading in a sideways trading range since October of last year. And every time we tried to test that area, basically we sort of failed. We went up to 88.97 in mid-January and have come off there again, retested the December to January uptrend line, and have done so again yesterday, and currently hold there around the 87.62 mark. So short term, we seem to be bouncing off the support line and could be heading back up again towards 88.52. But if we were to fall through yesterday's low at 87.62, we could be heading back down again towards the January low at 87.22 and back towards the 88 area. But short term, we seem to be bouncing off the support line here, and that looks quite constructive for euro sterling. Now, I'd like to finish up with regards to currencies on the Australian dollar versus the US dollar, because here we can also see that the US dollar is strengthening versus the Australian dollar and has come off its 71.42 high, a level last seen back in August of 2022, just above the August high. We made that high just last week, but now we're coming off there again and slipping back towards potential support, which can be seen between the September high at 69.16 and also the December high at 68.93. So that's a potential support area. But as long as we stay below the last reaction low, which is the 19th of January low here at 68.72, the uptrend here with a series of higher highs and higher lows remains intact. So this might just be a short-term retracement in a longer-term uptrend. And we can see here we've also got the uptrend line going back to November in place, and that holds as well. And we're also still trading above the 200-day simple moving average here in red at 68.12. And basically that tells us that the currency pair is still looking bullish despite the short-term retracement lower. Now, the price of gold has also come off over the last few days. If you look at the daily chart of gold, we are currently falling through the November to January uptrend line. And if we were to also fall through the mid-January low at $1,897 per troy ounce, then we could form a minor top here. And that would probably take us back down again towards the high seen back in June of last year at 1,877. So that would be our next downside target if we were to fall through $1,897 per troy ounce this week. As long as it holds, though, we have a series of higher highs and higher lows, and we're just seeing a sideways to slightly down consolidation in a very healthy uptrend, as you can see here, going back to November of last year. So it might just be the uptrend flattening out, consolidation short term, perhaps taking us back towards $1,870 or so, and then a resumption of the uptrend. So we'll have to see in the days ahead. But short term, as we can see here, we are falling through an uptrend line, which is still short-term negative with regards to the price of gold. Now, I'd like to also look at Brent crude oil, because crude oil has come off over the last 3 days as well on the rising US dollar, but also more importantly because of strong Russian exports and concerns that OPEC Plus will leave output levels unchanged. And here, that has pushed the price of oil lower again. We technically, which is very interesting, failed at the important resistance area I've been mentioning for the past 2 months, really, in that it is made up of the mid-October low and the highs seen back at the end of November between $87.99 and $89.35. And as long as we stay below that high, the early December high at $89.35, we remain in a downtrend, even though we've seen this consolidation fade to the upside. And that could actually turn out to be just an ABC zigzag correction in terms of value waves, meaning that we could see another move down towards these lows and perhaps take us to new lows below the $75 mark. So short term, we're now seeing an acceleration to the downside with regards to the oil price, and the fact that we once again failed, having tried twice to break through this key resistance area, is also telling us that the next few days are likely to be with regards to lower oil prices being seen and not higher prices on the back of that news with regards to OPEC Plus perhaps not raising its, well, basically leaving output levels where they are at the moment. Let's finish up on aluminium prices, because the price of aluminium has also risen very nicely since the beginning of the year. And last week basically failed at its 7-month high at $2,678 per metric ton. And since then has come off pretty sharply yesterday. Again, partly on the back of the rising dollar, but also on worries to do with perhaps the global economy slowing down. And here we can see that we are very close to the 2,555 level. That's the 19th of January low. And if that were to be taken out, we would most likely head back down towards the red line here, the 200-day simply moving average at 2,493. So that would be our next downside target. And in that scenario, we could see a topping formation perhaps take us even lower towards the highs seen at the end of December, around the $2,433 mark. So here, short term, again, negative momentum is probably dragging the price of aluminium down in the short term. And for us to be positive again, we really need to take out the current January high, 2,678. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.